Hello and welcome to another session of the My Solo 401k Financial My Community Daily Webinar Series. We're excited to discuss real-world examples, mega backdoor Roth, solo 401k strategies for side hustlers. The presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Please subscribe to our channel as we go live on a daily basis. You can come and ask questions and hear what other people are asking. We really appreciate the chance to discuss these topics, so please don't hesitate to chat over questions or topics. I always like to start out with some basic foundational content. So just in terms of, a solo 401k, it is for a self-employed individual. So think like a solo practicing professional, could be a medical professional, could be a CPA, could be just an independent contractor. The key is that you're self-employed with no full-time W-2 employees working for any business owned by you or a spouse, if any. Now, you don't need to have a formal legal entity in order to be eligible to set up a plan. We have many customers, for example, who operate as sole proprietors. The key is that you're reporting earned self-employment income on your taxes with no non-owner, non-spouse, full-time W-2 employees. So earned income could be income reported on Schedule C, for example, for a business that's taxed as a sole proprietor, or it could be income that's reported on a W-2, for example, for a business that's taxed as an S-Corp. Your spouse or business partner can participate as long as your spouse or business partner are reporting their own earned self-employment income, such as their own Schedule C or their own W-2. You can have a solo 401k even if you've got a W-2 day job, even if you participate in your W-2 employer-sponsored plan. Again, as long as you got that earned self-employment income. Now, we wanted to discuss, as mentioned, mega backdoor Roth solo 401k examples, contribution examples for those with side hustles. So people that have a day job and then they got a self-employed side business. Now we want to focus on today for businesses that are taxed as an S-Corp. So continuing to lay the foundation as far as, the mega backdoor Roth, the ability to make mega backdoor Roth contributions will allow someone to contribute all the way up to the overall limit. For example, $70,000 for 2025 between Roth and after-tax contributions, where all the funds end up in a Roth account where you've got that potential for tax-free growth. So the key elements is you need to be self-employed. Again, that means you're self-employed with no full-time W-2 employees, and then work with a provider like us that offers the plan that allows for voluntary after-tax contributions and then in-service distributions. And it's best to work with a company like us that has deep experience in helping people through all the required steps, such as the steps that are going to require having separate sub-accounts. There's going to be ongoing compliance support, such as a 1099-R that needs to be issued. So we handle all of that as an optional free service for our customers. Now, as far as determining these different contribution scenarios, it's going to be helpful to understand how much you can contribute depends on certain factors. For example, it depends on your income, depends on your age, it depends on whether you participate in another plan like a day job plan, the type of contribution that you're looking to make. So for a business that's taxed as an S-Corp, again, that's the focus of today's session, your self-employment income is equal to your W-2 wages from your S-Corp. Now, you cannot consider wages from other jobs, like a day job. And again, today's focus is the scenarios. We're talking about somebody that has a day job and then they also have a side hustle. You also can't consider investment income, like a K-1 that you might get from the S-Corp. So specifically, you're going to use box 1 of the W-2, plus any pre-tax elected deferrals not in box 1, but over in box 12. And that's going to be your W-2 wages. That's going to be your self-employment income for purposes of making solo 401k contributions. Another good factor to consider is that you've got the overall limit. Now for 2025, that went up to $70,000. And now you can also do catch-up contributions, such as $7,500 if you're age 50 or older, or $11,250 instead of $7,500 if you're age 60 to 63, what they call the super catch-up contribution limit. Now, you also have different sub-limits to attend to or to comply with. So again, for today's focus of the mega backdoor Roth solo 401k, it's going to be helpful to understand that when you make a mega backdoor Roth contribution, you're really making what's called a voluntary after-tax contribution. So the voluntary after-tax contribution limit is 100% of your self-employment compensation. Remember, for a business tax as an S-Corp, that's the W-2 wages. So dollar for dollar up to the overall limit, which is $70,000 for 2025. And then, of course, you got to consider that overall limit. So it would be reduced by any other contributions that you make to the solo 401k, like any employee or any employer. Now, it's noteworthy that this after-tax limit doesn't go up if you're age 50 or older. So you can make those catch-up contributions or super catch-up if you're age 60 to 63, if you got the self-employment income to justify it, but you wouldn't make those catch-up or super catch-up contributions as after-tax contributions. Instead, you'd have to make them either as employee pre-tax or employee Roth. Now, when you make these after-tax contributions, it needs to be deposited into a separate after-tax account before it gets moved over to a Roth account. And then it's also noteworthy that unlike the employee limit, which applies at the employee level, meaning that your ability to contribute employee contributions to the solo 401k is reduced by any employee contributions that you make to another plan. The after-tax limit, which is how one makes mega backdoor Roth contributions, is not impacted by contributions made to another plan through an unrelated employer, like a day job plan. Because again, our scenario here is mega backdoor Roth contribution examples for those that have a side hustle. So that implies that they have a day job. So they might be participating in their day job plan. So it's noteworthy that any contributions that they make to their day job plan are not going to reduce their ability to make mega backdoor Roth, meaning voluntary after-tax contributions to the solo 401k. So the one exception to that general rule is the 403b exception, because all contributions made to a 403b, whether employee or employer, together with any contributions that the person wants to make to the solo 401k, the sum cannot exceed the overall limit, for example, $70,000 for 2025. So now that we've laid the foundation, let's start to go through some scenarios, and then we will go to the good question that's been chatted up. Thank you for bringing the question. So we're going to start out with a self-employed business that say tax as an S-Corp. The person's under age 50. They do max out contributions to their day job plan, but their goal is to be able to maximize Roth and or voluntary after-tax contributions to the solo 401k, and they have $100,000 of W-2 wages from their self-employed business. So they're not going to be able to make any employee contributions to the solo 401k because, again, that employee limit applies at the employee level. They're not interested in making employer pre-tax contributions. They're only interested in making Roth or voluntary after-tax contributions. So they're going to be able to contribute 100% dollar for dollar of their self-employment income, in this case, the W-2 wages from their S-Corp, up to $70,000 for 2025. Or if they set up a plan either before the end of last year, or if they set it up now here in 2025 by their business tax return deadline, including any timely filed extension. So let's say that their business is taxed as an S-Corp and they filed an extension for their 2024 S-Corp tax return. They could still make the voluntary after-tax contributions for 2024 anytime up until that extended tax return deadline. In other words, September 15th for a business that's filed a timely extension for their S-Corp return. So now let's change the scenario. So now we're going to say we got the same person, but they're 50 or older. But again, they've maxed out their contributions to their day job plan, but their goal is still to be able to maximize Roth and voluntary after-tax contributions to the solo. So they would end up contributing the same amount. They could contribute the same amount all the way up to the overall limit as an after-tax contribution. So this is a good example as it illustrates that catch-up contribution, as I noted, doesn't increase your ability to make after-tax contributions. Instead, that catch-up contribution needs to be made as an employee contribution. And in this case, this person has a side hustle. They participate in their 401k at their day job, and they maxed out the contribution, including the catch-up contribution to their day job plan. So they can only make that catch-up contribution one time, and they made it to the day job plan. So now let's change up the scenario, and let's assume that it's two people, let's say a husband and wife that are both working in the same business, both working, say, in the S-Corp that sponsors the solo 401k. They each receive $100,000 of W-2 wages from their day job. They each, their $100,000 of W-2 wages from their self-employed business, taxed as an S-Corp. They each do have a day job, and they each maximize contributions to their day job plan, and they're looking to maximize Roth or mega backdoor Roth contributions. So it's going to be the same numbers as the first scenario. The key takeaway here is that the ability for each person to contribute to the plan is going to be based on their specific situation, right? Their age, whether they make contributions to a day job plan, their self-employment compensation. And since in this case, each person, each spouse has the exact same scenario, right? They're each the same age. They each have $100,000 of W-2 wages from the S-Corp. They each max out contributions to their day job plan. They're each only interested in making Roth and mega backdoor Roth contributions. They're not going to be able to make employee contributions because they already hit their limit under their day job plan. They're not interested in making employer pre-tax contributions, and they can contribute 100% of their self-employment compensation up to the overall limit as a voluntary after-tax contribution. So that brings us to the deadline. So before we talk about the deadline, let's field this good question. Thank you for bringing the question. Can you distinguish between net profit from an LLC taxed as a partnership versus an 1120S? So for purposes of making contributions to a solo 401k where the business is taxed as a partnership, you use line 14 of the K1 less 1/2 of the self-employment tax. And that gives you self-employment compensation on which you determine how much you can contribute. Thank you so much for the great question. We appreciate the good participation. So again, if there's more questions or topics, please don't hesitate to chat it over. If you are finding this to be helpful, if you could please like the video, that helps us get the word out to other entrepreneurs just like you to help us get this information out to them, right? There's a growing number of course, self-employed individuals. So it'd be great if you could participate in helping other entrepreneurs like you understand this information. So if you would like, that really helps us to get the word out. So thank you so much. So as far as the deadline to make contributions, it's going to depend on how the business is taxed. So technically, there's still time, for example, for a business that's taxed as a sole proprietorship to open up a plan here in 2025 and make all types of contributions for 2024. And that's because of the Secure Act 2.0. So you could still open up a plan in 2025 and make employee contributions as long as you do so by April 15th. And then if you file a timely extension for your 1040, which is effectively your business tax return for a business that's taxed as a sole proprietorship, if you file a timely extension, you could even make employer or voluntary after-tax contributions for 2024 by the extended tax return deadline. Now, of course, if you had set up a plan with us or somewhere else, maybe a basic plan at like Fidelity or Schwab before the end of last year, and now you want to upgrade your basic plan to our plan, or you already signed up with us before the end of last year, you would have preserved the ability to make all types of contributions, even employee contributions, by the extended tax return deadline of October 15th if you filed a timely extension for your 1040. Now, for other business types like partnership, S-Corp, C-Corp, if you signed up with us before the end of last year or you set up a basic plan somewhere else that now you want to upgrade to our plan, you would have preserved the ability to make all types of contributions for 2024, employee, employer, and voluntary after-tax by the extended tax return deadline, or the regular deadline or the extended deadline. So in the case of a partnership, for example, if you filed a timely extension for your 1065, now you'll have until September 15th to make all types of contributions, again, assuming you set up a plan before the end of last year. Now, if you didn't set up a plan before the end of last year and your business is not taxed as a sole proprietorship, again, partnership, S-Corp, C-Corp, it's too late to be able to make employee contributions for 2024, but there's still time potentially to set up a plan in 2025 and make either employer or voluntary after-tax. As long as you set up the plan in time to make those employer or voluntary after-tax contributions for 2024 by the tax return deadline, including any timely filed extension. So let's say your business is taxed as a partnership. You filed an extension for your 2024 1065, giving you until September 15th. You didn't set up a plan before the end of last year. You could still set up a plan here in 2025 and at least make employer or voluntary after-tax contributions by that September 15th deadline. Hopefully that makes sense. So please continue to participate. You can come to our community. We have over 30,000 members. We have vibrant forums. We have a library of videos and webinars. You can follow us on YouTube or LinkedIn or StreamYard or wherever you're watching us today, and you get notifications of when we go live. Again, if you're finding it helpful, if you please like the video, that helps us get the word out to other entrepreneurs, to other solopreneurs and freelancers just like you, to help us get this valuable information so people can, save and take control of their retirement. Thank you so much. We'll give it a moment to see if there's any more questions. So if you were reporting self-employment activity in 2024 and you will continue to do so into 2025 and then into the future indefinitely, you could set up a plan for 2024, but you wouldn't be able to make any contributions if you don't have any positive income. So really, there's no point from a contribution perspective. But yes, and you could just make it effective for 2025 if you're not going to make it. If you're not going to make any 2024 contributions, and again, as long as you're reporting that earned self-employment income, there's no employees, you're working towards obviously making the business profitable. It's not just a hobby business or something like that. Then yeah, you can definitely set up a plan. There's no minimum contribution amount. There's no minimum amount of earned self-employment income that's needed. In other words, it's not just for, bigger businesses. It could be for micro businesses or businesses that are just getting started, and you can roll over money as long as it's coming from an account that's eligible to be rolled over, like a former employer plan or a non-Roth IRA. So the answer is yes. Please feel free to schedule a call at mysolo401k.net/book. All right, everyone. Thank you so much for the great participation. Until next time.